Hi, welcome to our channel of IGNOU audiobooks, Indira Gandhi National Open University, School of Management Studies, SOMS, Diploma, Postgraduate Diploma Programs, Postgraduate Diploma in Financial Management, PGDIFM, Semester I, mmpc-004 Accounting for Managers, Block-1 Accounting, an Overview. Unit-1 Introduction to Accounting. 1.1 Introduction. Accounting is often called the language of business. The basic function of any language is to serve as a means of communication. In this context, the purpose of accounting is to communicate or report the results of business operations and its various aspects. Accounting has been defined in various ways. According to one commonly accepted definition, accounting is the art of recording, classifying and summarizing in a significant manner and in terms of money, transactions and events which are, in part at least, of financial character and interpreting the results thereof. Another definition, which is less restrictive, interprets accounting as the process of identifying, measuring and communicating economic information to permit informed judgments and decisions by the users of information. 1.20 BJECTIVESAND Scope of accounting. The main objectives of accounting are to maintain a systematic record of business transactions. Accounting is prepared to maintain a systematic record of all the financial transactions or monetary transaction in a book of accounts. For this purpose, all the transactions are recorded in chronological order in journal and then posted to principal book, i.e., ledger, trial balance, to ascertain profit and loss. Every businessman is curious to know the net results of business operations periodically, in order to find out whether the business has earned profits or incurred losses. We prepare profit and loss account to determine the financial position. Another important objective is to determine the financial position of the business, to check the value of assets and liabilities. For this purpose, we prepare balance sheet to provide information to various users. The most important objectives of accounting is to provide information to the various interested parties or stakeholders. The information provided by accounts helps them in making good financial decisions. To assist the management by analyzing financial data and providing interpretations in the form of reports, accounting assists management in handling business operations effectively. Scope of accounting. The scope of accounting can be presented in a diagrammatic form as shown in Figure 1.1. Look at the screen. Data creation and collection is the area which provides raw material for accounting. The data collected is historic, in the sense that it refers to events which have already taken place. Earlier, accounting was largely concerned with what had happened, rather than making any attempt to predict and prepare for future. After the historic data has been collected, it is recorded in accordance with generally accepted accounting theory. A large number of transactions or events have to be entered in the books of original entry, journals, and ledgers, in accordance with the classification scheme already decided upon. The recording and processing of information usually accounts for a substantial part of total accounting work. This type of activity of accounting may be called recordative. The processing method employed for recording may be manual, mechanical, or electronic. Computers are also used widely in modern business for doing this job. Data evaluation is regarded as the most important activity in accounting. These days, evaluation of data includes controlling the activities of business with the help of budgets and standard costs, budgetary control, evaluating the performance of business, analyzing the flow of funds, and analyzing the accounting information for decision-making purposes by choosing among alternative courses of action. The analytical and interpretative work of accounting may be for internal or external uses and may range from snap answers to elaborate reports produced by extensive research. Capital project analysis, financial forecasts, budgetary projections and analysis for reorganization, takeover or merger often lead to research-based reports. Data evaluation has another dimension, and this can be known as the auditive work, which focuses on verification of transactions as entered in the books of account and authentication of financial statements. This work is done by public professional accountants. However, it has become common these days for even medium-sized organizations to engage internal auditors to keep a continuous watch over financial flows and review the operation of the financial system. Data reporting consists of two parts: external and internal. External reporting refers to the communication of financial information, viz., earnings, financial and funds position, about the business to outside parties, e.g., shareholders, government agencies and regulatory bodies of the government. Internal reporting is concerned with the communication of results of financial analysis and evaluation to management for decision-making purposes. You will note that accounting theory has been shown in the center of the diagram. The central purpose of accounting is to make possible the periodic matching of costs, efforts, and revenues, accomplishments. This concept is the nucleus of accounting theory. However, accounting is moving away from its traditional procedure-based record-keeping function to the adoption of a role which emphasizes its social importance. 1.3 Definition of accounting. Accounting can be defined as a process of reporting, recording, interpreting, and summarizing economic data. The introduction of accounting helps the decision makers of a company to make effective choices by providing information on the financial status of the business. Accounting is a system which identifies the transaction, record those transaction of a business organization in a way that can be compared with the other business as well as within the business with the past performance. Accounting is a part of our daily life. A person most common use of accounting is to check accounts, tax forms, payroll, any credit taken. All these experience focus on record-keeping part of accounting. Nowadays, due to advancement of technology, the recording part is done with the help of technology. Still, the analysis is done by human minds, thus understanding the various concepts of accounting is important. The American Institute of Certified Public Accountants, AICPA, had defined accounting as the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions and events which are, in part at least, of financial character, and interpreting the results thereof. As per Robert N. Anthony, accounting system is a means of collecting, summarizing, analyzing and reporting, in monetary terms, information about the business. To understand accounting efficiently, it is important to understand the following aspects of accounting. Economic events. Economic events are those which are a result of a consequence of a monetary transaction which company has to undergo during its lifetime, such as purchasing new machinery, transportation, machine installation on site, etc. Identification, measurement, recording, and communication. The purpose of accounting system should be elaborated in such a way that the right data is identified, measured, recorded and communicated to the right individual and at the right time. Organization. It refers to the size of business and the types of activities. Assets. Assets are those resources owned by organization which helps the company to earn profit. The economic value of an item which is possessed by the enterprise is referred to as assets, e.g., plant and machinery, furniture and fittings, land and buildings, books, computers, motor vehicles, etc. Assets can tangible which can be seen or touched and intangible, for example, goodwill, patent, etc. Liabilities. The economic value of an obligation or debt that is payable by the enterprise to other establishment or individual is referred to as liability. In other words, liabilities are the obligations or responsibility that arise out of previous transactions, which is payable by the enterprise, through the assets possessed by the enterprise. Liabilities can be classified as fixed and current. For example, outstanding expenses, debentures, loans from banks and financial institutions. Owner's equity. Owner's equity is one of the three vital segments of a sole proprietorship's balance sheet and one of the main aspects of the accounting equation. Assets equals liabilities plus owner's equity. It represents the owner's investment capital in the trade minus the owner's withdrawal from the trade drawings plus the net income since the business concern commenced. 1.3.1 Steps in accounting cycle. The following attributes or characteristics can be drawn from the definition of accounting. Identifying financial transactions and events. Only those transactions and events which are of financial nature. Therefore, first of all, such transactions and events are identified. Measuring the transactions. The transactions and events are measured in terms of money, which is considered as a common unit. Recording of transactions. Accounting involves recording the financial transactions in appropriate book of accounts such as journal or subsidiary books. Classifying the transactions. Transactions recorded in the books of original entry, journal or subsidiary books are classified and grouped according to nature and posted in separate accounts known as ledger accounts. Summarizing the transactions. It involves presenting the classified data in a manner and in the form of statements, which are understandable by the users. It includes trial balance, trading account, profit and loss account and balance sheet. Analyzing and interpreting financial data. Results of the business are analyzed and interpreted so that users of financial statements can make a meaningful and sound judgment. Communicating the financial data or reports to the users. Communicating the financial data to the users on time is the final step of accounting so that they can make appropriate decisions. It not only classifies and summarizes the business data but also analyzes and interprets the results for the future decisions. 1.3.2 Bookkeeping vs. Accounting. Bookkeeping. It is a component of accounting that involves the process of identifying the financial transactions, measuring, recording, and classifying those transactions that have occurred in the course of business. Accounting. Accounting begins where bookkeeping ends. It is a wider concept and includes summarizing, interpreting and communicating the financial data to the users of financial statements. Accountancy. Accountancy refers to systematic knowledge of the accounting principles and the techniques, parameters of bookkeeping and accounting. Look at the screen. 1.3.3 Systems of accounting. There are following two systems of recording transactions in the books of accounts. 1. Double entry system. 2. Single entry system. Double entry system. The double entry system is based on the dual aspect principle. Every transaction has two aspects, a debit and a credit of an equal amount. This system of accounting recognizes and records both aspects of the transaction. Minimum two accounts are involved. The accounting equation should not be violated. Single entry system. Under this system, both aspects are not recorded for all the transactions. Either only one aspect is recorded or both the aspects are not recorded for all the transactions. Advantages of the double entry system of accounting. Following are the main merits of the double entry system of accounting. 1. Scientific system. As compared to the single entry systems, this system is more scientific and is useful to achieve the objective of accounting. 2. A complete record of the transaction. Since both the aspects of transactions are considered, thus there is a complete recording of each and every transaction. Using these records one can compute profit or loss easily. 3. Checks arithmetical accuracy of accounts. Under this system, one can check the arithmetical accuracy of the records by preparing a trial balance. 4. Determination of profit, loss and depiction of financial position. Under this system one get to know about the profit earned or loss incurred by preparing profit and loss A, C, we get. By preparing the balance sheet, the financial position of the business can be ascertained, i.e., position of assets and liabilities is depicted. 5. Helpful in decision making. Under the double entry system of accounting, administration and management are able to take decisions on the basis of factual information. 1.3.4 Applications of accounting. The following are the main applications of accounting. Provide information about financial performance. Accounting provides factual information about the financial performance of an enterprise during a given time period. It provides information like profit earned or loss incurred over a period of time, through profit and loss statement, and financial position through balance sheet, at a particular point of time. Provide assistance to management. Accounting also assists the management in business planning, decision making and in exercising control by providing financial information in the form of reports. Facilitates comparative study. Accounting helps in making a comparison by keeping a systematic records and preparation of reports at regular intervals. Helps in settlement of tax liability. Systematic accounting records further help in settlement of various tax liabilities such as income tax, GST, etc. Helpful in raising loan. On the basis of appraisal of the financial statement of the firm, banks and financial institutions grant a loan to the firm. Helpful in decision making. Accounting also provides useful information to the management for taking vital decisions. Substitute of human memory. Since it is difficult for a human to remember all the transactions of the business, accounting serve as a substitute of human memory by recording all the transaction and keep all information handy as and one require. Helps in the valuation of business. In case of the shutdown and dissolution of business, accounting helps the businessman to determine the value of business, otherwise it is not possible to determine value of business. A. Limitations. Following are the limitations of accounting. Accounting is not precise. Accounting is often subjected to personal bias or judgment. Accounting is done on historic values of assets. Accounting records assets at their historical cost less depreciation and does not reflect their current market value. Ignore the effect of price level changes. Accounting statements are prepared at historical cost and thus ignores the changes in the value of money. Ignore the qualitative information. Accounting ignores the qualitative aspects as it records only monetary transactions. Affected by window dressing. Window dressing means manipulation in accounting, in order to present a more favorable position of the business than the actual position. 1.3.5 Qualitative characteristics of accounting information. Qualitative characteristics are the attributes of accounting information, which enhance its understandability and usefulness. Reliability. Reliability means that the information must be free from material error and personal bias. Unless the information is reliable, the accounting records cannot be prepared accurate. Relevance. To be useful, accounting information must be relevant to the decision-making requirements of the users. Understandability. Information should be disclosed in financial statements in such a manner that these are easily understandable. Comparability. Both intra-firm and inter-firm comparison must be possible over different time periods. That is, the performance of company can be compared with its previous performance and with other companies also. 1.4 Accounting as an information system. While discussing the scope of accounting, you must have observed that accounting involves a series of activities linked with each other, beginning with the collecting, recording, analyzing and evaluating the data, and finally communicating information to its users. Information has no meaning unless it is linked with a certain purpose. Accounting as a social science can be viewed as an information system since it has all the features of a system. It has its inputs, raw data, processes, men and equipment, and outputs, reports, and information.
If we consider accounting as an information system, then we are in a position to make some important observations. First, the goal of the system is to provide information which meets the needs of its users. If we can correctly identify the needs of the users, we are then able to specify the nature and character of the outputs of the system. Secondly, it is the output requirements that determine the type of data which would be selected as the inputs for processing into information output. There are several groups of people who have a stake in a business. Organization managers, shareholders, creditors, employees, customers, etc. Additionally, the community at large has economic and social interest in the activities of such organizations. This interest is expressed at the national level by the concern of government in various aspects of the firm's activities, such as their economic well-being, their contribution to welfare, their part in the growth of the national product, to mention only a few examples. We shall now briefly discuss what the information needs of various users are. Shareholders and investors. Since shareholders and other investors have invested their wealth in a business enterprise, they are interested in knowing periodically about the profitability of the enterprise, the soundness of their investment and the growth prospects of the enterprise. Historically, business accounting was developed to supply information to those who had invested their funds in business enterprises. Creditors may be short-term or long-term lenders. Short-term creditors include suppliers of materials, goods or services. They are normally known as trade creditors. Long-term creditors are those who have lent money for a long period, usually in the form of secured loans. The main concern of the creditors is focused on the creditworthiness of the firms and its ability to meet its financial obligations. They are therefore concerned with the liquidity of the firms, its profitability and financial soundness. In other words, it can also be stated that creditors are interested mainly in information which deals with solvency, liquidity and profitability so that they could assess the financial standing of the firms. Employees, the view that business organizations exist to maximize the return to shareholders has been undergoing change as a result of social changes. A broader view is taken today of economic and social role of management. The importance of harmonious industrial relations between management and employees cannot be overemphasized. That the employees have a stake in the outcomes of several managerial decisions is recognized. Greater emphasis on industrial democracy through employee participation in management decisions has important implications for the supply of information to employees. Matters like settlement of wages, bonus, and profit sharing rest on adequate disclosure of relevant facts. Government. In a mixed economy, it is considered to be the responsibility of the government to direct the operation of the economic system in such a manner that it subserves the common good. Controls and regulations on the operations of private sector enterprises are the hallmark of mixed economy. Several government agencies collect information about various aspects of the activities of business organizations. Much of this information is a direct output of the accounting system, for example, levels of outputs, profits, investments, costs, and taxes, etc. All this information is very important in evolving policies for managing the economy. The task of the government in managing the industrial economy of the country is facilitated if accounting information is presented, as far as possible, in a uniform manner. It is clear that if accounting information is distorted due to manipulations and window dressing in the presentation of annual accounts, it will have ill effects on the measures the government intends to take and the policies it wishes to adopt. Management organizations may or may not exist for the sole purpose of profit. However, information needs of the managers of both kinds of organizations are almost the same, because the managerial process, i.e., planning, organizing and controlling, is the same. All these functions have one thing in common, and it is that they are all concerned with making decisions which have their own specific information requirements. The emphasis on efficient and effective management of organizations has considerably extended the demand for accounting information. The role of accounting as far as management is concerned was highlighted earlier when we discussed about management accounting. Consumers and others, consumers, organizations, media, welfare organizations and public at large are also interested in condensed accounting information in order to appraise the efficiency and social role of the enterprises in different sectors of the economy, that is, what levels of profits and outputs are being achieved, in what way the social responsibility is being discharged, and in what manner the growth is being planned by the enterprises in accordance with the national priorities, etc. The above discussion perhaps has indicated to you that the information needs of the various users may not necessarily be the same. Sometimes, they may even conflict and compete with each other. In any case, the objective of accounting information is to enable information users to make optimum decisions. 1.4.1 Nature of accounting function. Accounting is a service function. The chief accounting executive, by whatever name he is called, holds a staff position except within his own department where he exerts authority. This is in contradistinction to the roles played by production or marketing executives who hold line authority. The role of the accountant is advisory in character. He works through the authority of the chief executive. The accounts and/or finance departments exercise direct authority over line departments. In decentralized structure with a number of units and divisions, the accounting executive, however, exercises what is known as the functional authority over all the accounting staff deployed in different segments. There are two facets to the role of the accountant. For the top managers, he works as a watchdog, and for middle and lower level managers he acts as helper. The watchdog role is usually performed through scorekeeping task of accounting and reporting to all levels of management. The helper role is usually performed through the task of directing managers' attention to problems and assisting them in solving problems. Mutual understanding and rapport between the accountant and the manager in the tasks of attention directing and problem solving can be enhanced if accountant and his staff frequently interact with the line managers and guide them in matters concerned with preparation of budgets and control documents with which they might not be conversant. This will instill confidence among line managers regarding the reliability of reports. 1.5 Emerging role of accounting. The history of accounting indicates the evolutionary pattern which reflects changing socioeconomic conditions and the enlarged purposes to which accounting is applied. In the present context, 4 phases in the evolution of accounting can be distinguished. Stewardship accounting. In earlier times in history, wealthy people employed stewards to manage their property. These stewards rendered an account of their stewardship to their owners periodically. This notion lies at the root of financial reporting, even today, which essentially involves the orderly recording of business transactions, commonly known as bookkeeping. Indeed, the accounting concepts and procedures in use today for systematic recording of business transactions have their origin in the practices employed by merchants in Italy. During the 15th century, the Italian method, which specifically began to be known as double-entry bookkeeping, was adopted by other European countries during the 19th century. Stewardship accounting, in a sense, is associated with the need of business owners to keep records of their transactions, the property and tools they own, debts they owed, and debts others owed them. Financial accounting. Financial accounting dates from the development of large-scale business and the advent of joint stock company, a form of business which enables the public to participate in providing capital in return for shares in the assets and the profits of the company. This form of business organization permits a limit to the liability of their members to the nominal value of their shares. This means that the liability of a shareholder for the financial debts of the company is limited to the amount he had agreed to pay on the shares he bought. He isn't liable to make any further contribution in the event of the company's failure or liquidation. As a matter of fact, the law governing the operations or functioning of a company in any country, for instance the Companies Act in India, gives a legal form to the doctrine of stewardship, which requires that information be disclosed to the shareholders in the form of annual income statement and balance sheet. Briefly speaking, the income statement is a statement of profit and loss made during the year of the report, and the balance sheet indicates the assets held by the firm and the monetary claims against the firm. The general unwillingness of the company directors to disclose more than the minimum information required by law and the growing public awareness have forced the governments in various countries of the world to extend the disclosure of information requirements. The importance attached to financial accounting statements can be traced to the need of the society to mobilize the savings and channel them into profitable investments. Investors, whether they are large or small, must be provided with reliable and sufficient information in order to be able to make efficient investment decisions. This is the most significant social purpose of financial accounting. Cost accounting. The Industrial Revolution in England presented a challenge to the development of accounting as a tool of industrial management. Costing techniques were developed as guides to management actions. The increasing awareness on the part of entrepreneurs and industrial managers for using scientific principles of management in the wake of scientific management movement led to the development of cost accounting. Cost accounting is concerned with the application of costing principles, methods and techniques for ascertaining the costs with a view to controlling them and assessing the profitability and efficiency of the enterprise. Management accounting. The advent of management accounting was the next logical step in the developmental process. The practice of using accounting information as a direct aid to management is a phenomenon of the 20th century, particularly the last 30 to 40 years. The genesis of modern management with its emphasis on detailed information for decision making provide a tremendous impetus to the development of management accounting. Management accounting is concerned with the preparation and presentation of accounting and controlling information in a form which assists management in the formulation of policies and in decision making on Various matters connected with routine or non-routine operations of business. Enterprise. It is through the techniques of management accounting that they managers are supplied with information which they need for achieving objectives for which they are accountable. Management accounting has thus shifted the focus of accounting from recording and analyzing financial transactions to using information for decisions affecting the future. In this sense, management accounting has a vital role to play in extending the horizons of modern business. While the reports emanating from financial accounting are subject to the conceptual framework of accounting, internal reports, routine or non-routine, are free from such constraints. Social responsibility accounting. Social responsibility accounting is a new phase in the development of accounting and owes its birth to increasing social awareness, which has been particularly noticeable over the last 2 decades or so. Social responsibility accounting widens the scope of accounting by considering the social effects of business decisions, in addition to the economic effects. Several social scientists, statesmen and social workers all over the world have been drawing the attention of their governments and the people in their countries to the dangers posed to environment and ecology by the unbridled industrial growth. The role of business in society is increasingly coming under greater scrutiny. The management is being held responsible not only for efficient conduct of business as expressed in profitability, but also for what it contributes to social well-being and progress. There is a growing feeling that the concepts of growth and profit as measured in traditional balance sheets and income statements are too narrow to reflect the social responsibility aspects of a business. Human resource accounting. Way back in 1964, the first attempt to include figures on human capital in the balance sheet was made by Hermansen, which later came to be known as human resource accounting. However, there had been a great socio-economic shift in the 1990s with the emergence of knowledge economy, a distinctive shift towards recognition of human and intellectual capital in contrast to physical capital. Human resource accounting is a branch of accounting which seeks to report and emphasize the importance of human resources, knowledgeable, trained, loyal and committed employees, in a company's earning process and total assets. It is concerned with the process of identifying and measuring data about human resources and communicating this information to interested parties. In simple words, it involves accounting for investment in people and replacement costs, as well as accounting for the economic values of people to an organization. Generally, the methods used for valuing and accounting of human resources are either based on costs or on economic value of human resources. However, providing adequate and valid information on human assets, capital, which are outside the concept of ownership, in figures is very difficult. Nevertheless, HRA is a managerial tool, providing valuable information to the top management to take decisions regarding adequacy of human resources and thus encouraging managers to consider investment in manpower in a more positive way. Inflation accounting. Inflation accounting is concerned with the adjustment in the value of assets, current and fixed, and of profit in the light of changes in the price level. In a way, it is concerned with the overcoming of limitations that arise in financial statements on account of the cost assumption, that is, recording of the assets at their historical or original cost, and the assumption of stable monetary unit. These are discussed in detail in the next unit. It thus aims at correcting the distortions in the reported results caused by price level changes. Generally, rising prices during inflation have the distorting influence of overstating the profit. Various approaches have been suggested to deal with this problem. 1.6 Accounting personnel. There is hardly any organization which does not have an accountant. His role is all-pervasive and he is involved in a wide range of activities, particularly in a large and complex organization. The exact duties of an accountant might differ in different organizations. However, a broad spectrum of responsibilities can be identified. The accountants can be broadly divided into 2 categories, those who are in public practice and those who are in private employment. The accountants in public practice offer their services for conducting financial and/or cost audit. As such, they are known as auditors. The auditor examines the books of account and reports on the balance sheet and profit and loss account of the company as to whether they give a true and fair view of the state of affairs of the company and its profit respectively. The auditor in a company is appointed by the shareholders to whom he reports. Public accountants are generally members of professional bodies like the Institute of Chartered Accountants of India or the Institute of Cost and Works Accountants of India. In addition to conducting financial or cost audit, in accordance with the requirements of the Companies Act, as the case may be, they may also provide consultancy services for designing or improving accounting and management control systems. Accountants in employment may be in various business or non-business organizations to perform a variety of accounting and management control functions. Accountants at higher levels generally belong to professional accounting bodies, but those who are at lower levels need not be so. Accounting chiefs in different organizations, depending upon their nature of work, are variously designated as finance officers or internal auditors or chiefs accounts officers, etc. The term "controller" as the head of the accounting and finance function is not very popular in India, but of late it has been catching up. Several large organizations, both in the public and private sectors, have now controllers. Let us have an idea of who these people are and what they do. Internal auditor. Internal auditor is an employee of the organization in contrast to an external auditor who is paid a fee for his services. The internal auditor is responsible for performing monitoring activities and other services, including designing and operating the system of internal control, auditing the data reported to the directors of the company, and assisting external auditors. The head of the internal audit function and reports directly either to the chief executive or to the audit committee of the board of directors. Internal audit includes continuous verification of entries appearing in the books of account with the original vouchers and proper accounting of assets. Further, it attempts to ensure that the policies and procedures regarding financial matters are being complied with. Internal auditing is also concerned with administering the system of internal checks so that mistakes, innocent or intentional, are prevented from taking place. We should distinguish an internal auditor from an external auditor. While an internal auditor devotes his entire time and energy to the needs of one company, i.e., his employer, an external auditor serves many clients. The primary function of the external auditor, as pointed out earlier, is to safeguard the interests of the shareholders, by whom he is appointed, by an independent and impartial appraisal of the financial transactions of the company so that he could report on the net profit earned by the company and its financial position. His role is that of an objective outsider, expressing expert opinions to the financial condition and operating results of the client's business. Apart from shareholders, other parties such as banks, lending institutions, government agencies, etc., rely on the fairness of such financial reports in making certain decisions about a given company. An auditor is bound by a set of professional regulations which include an examination on technical competence and adherence to a code of ethical conduct. Controller. Controller, the other name for chief accountant, is usually the head of the whole area of accounting, including internal audit. He is overall in charge of all the activities comprising financial accounting, cost accounting, management accounting, tax accounting, etc. He exercises authority both for accounting within the organization and for external reporting. The external reports include reports to government revenue collecting and regulatory bodies, such as Company Law Board and Income Tax Department. He may also supervise the company's internal audit and control systems. In addition to processing historical data, he is expected to supply a good deal of accounting information to top management concerning future operations, in line with the management's planning and control needs. Besides, he is also expected to supply detailed information to managers in different functional areas, like production, marketing, etc., and at different levels of the organization. We may enumerate the functions of the controller as follows. A. Designing and operating the accounting system. B. Preparing financial statements and reports. C. Establishing and maintaining systems and procedures. D. Supervising internal auditing and arranging for external audit. A. Supervising computer applications. F. Overseeing cost control. G. Preparing budgets. H. Making forecasts and analytical reports. I. Reporting financial information to top management. J. Handling tax matters. Treasurer. He is the custodian and manager of all the cash and near cash resources of the firm. The treasurer handles credit reviews and sets policy for collecting receivables, debtors of the firm to whom the firm has sold goods or services. He also handles relationships with banks and other lending or financial institutions. The Financial Executive Institute of United States of America makes the following distinction between controllership and treasurership functions. Controllership functions: planning and control, reporting and interpreting, evaluating and consulting, tax administration, government reporting, protection of assets, economic appraisal, treasurership functions, provision of capital, investor relations, short-term financing, banking and custody, credit and collections, investments, insurance, finance officer. Finance is the lifeblood of business. Procuring financial resources and their judicious utilization are the two important activities of financial management. Financial management includes three major decisions: investment decision, financing decision, and dividend decision. Investment decision is perhaps the most important decision because it involves allocation of resources. It is concerned with future, which being uncertain involves risk. How the firm is allocating its scarce resources and is planning growth will largely determine its value in the marketplace. Financing decision is concerned with determining the optimum financing mix or capital structure. It examines the various methods by which a firm obtains short-term and long-term finances through various alternative sources. The dividend decision is concerned with questions like how much of the profit is to be retained and how much is to be distributed as dividends. The finance manager has to strike a balance between the current needs of the enterprise for cash and the needs of the shareholders for an adequate return. The financial management of a large company is usually the responsibility of the finance director, who may be in place of, or in addition to, the controller. Often finance manager and controller are interchangeable terms, and only one of these two positions may be found in a company. The finance manager, when there is a controller also in the organization, is concerned with implementing the financial policy of the board of directors, managing liquidity, preparation of budgets and administration of budgetary control system, managing profitability, etc. Though financial management is regarded as a separate area, this function is performed in several countries, including India, by the accountant, or the financial controller. Several large organizations, however, have a financial executive besides the chief accountant. Often, finance and accounting functions are clubbed together in one person in small organizations. 1.7 Accounting Framework. The rules and conventions of accounting are commonly referred to as the conceptual framework of accounting. As with any discipline or body of knowledge, some underlying theoretical structure is required if a logical and useful set of practices and procedures are to be developed for reaching the goals of the profession and for expanding knowledge in that field. Such a body of principles is needed to help answer new questions that arise. No profession can thrive in the absence of a theoretical framework. According to Hendrickson, 1977, accounting theory may be defined as logical reasoning in the form of a set of broad principles that 1. Provide a general frame of reference by which accounting practice can be evaluated, and 2. Guide the development of new practices and procedures. Accounting theory may also be used to explain existing practices to obtain a better understanding of them. But the most important goal of accounting theory should be to provide a coherent set of logical principles that form the general frame of reference for the evaluation and development of sound accounting practices. The American Institute of Certified Public Accountants, AICPA, discusses financial accounting theory and generally accepted accounting principles as follows. Financial statements are the product of process in which a large volume of data about aspects of the economic activities of an enterprise are accumulated, analyzed, and reported. This process should be carried out in accordance with generally accepted accounting principles. Generally accepted accounting principles incorporate the consensus at a particular time as to which economic resources and obligations should be recorded as assets and liabilities by financial accounting, which changes in assets and liabilities should be recorded, when these changes should be recorded, how the assets and liabilities and changes in them should be measured, what information should be disclosed and how it should be disclosed, and which financial statements should be prepared. Generally accepted accounting principles encompass the conventions, rules, and procedures necessary to define accepted accounting practice at a particular time. Generally accepted accounting principles include not only broad guidelines of general application, but also detailed practices and procedures. Source: AICPA Statements of the Accounting Principles Board No. 4, Basic Concept and Accounting Principles Underlying Financial Statement of Business Enterprises, October, 1970, pp.54-55. The word "principles" is used to mean a general law or rule adopted or Professed as a guide to action, a settled ground or basis of conduct or practice. You will note that this definition describes a principle as a general law or rule that is to be used as a guide to action. This implies that accounting principles do not prescribe exactly how each detailed event occurring in business should be recorded. Consequently, there are several matters in accounting practice that may differ from one company to another. Accounting principles are man-made. They are accepted because they are believed to be useful. The general acceptance of an accounting principle, or, for that matter, any principle, usually depends on how well it meets the three criteria of relevance, objectivity, and feasibility. A principle is relevant to the extent that it results in meaningful or useful information to those who need to know about a certain business. A principle is objective to the extent that the information is not influenced by the personal bias or judgment of those who furnished it. Objectivity connotes reliability or trustworthiness, which also means that the correctness of the information reported can be verified. A principle is feasible to the extent that it can be implemented without undue complexity or cost. 1.7.1 Accounting Concepts. Earlier, we had described accounting as the language of business. As with language, accounting has many dialects. There are differences in terminology. In dealing with the framework of accounting theory, one is confronted with a serious problem arising from differences in terminology. A number of words and terms have been used by different writers to express and explain the same idea or notion. Thus, confusion abounds in the literature. Insofar as the theoretical framework is concerned, the various terms used for describing the basic ideas are concepts, postulates, propositions, basic assumptions, underlying principles, fundamentals, conventions, doctrines, rules, etc. Although each of these terms is capable of precise definition, general usage by the profession of accounting has served to give them loose and overlapping meanings. The same idea has been described by one author as a concept and by another as a convention. To take another instance, the idea implied in conservatism has been labeled by one author as a modifying convention, by another as a principle, and yet by another as a doctrine. The wide diversity in terminology to express the basic framework can only serve to confuse the learner. Without falling into the trap of this terminological maze, we are explaining below some widely recognized ideas, and we call all of these concepts. We do feel, however, that some of these ideas have a better claim to be called concepts, while the rest should be called conventions. Fundamental accounting concepts are broad general assumptions which underlie the periodic financial accounts of business enterprises. The reason why some of these ideas should be called concepts is that they are basic assumptions and have a direct bearing on the quality of financial accounting information. The alteration of any of the basic concepts or postulates would change the entire nature of financial accounting. Business entity concept. In accounting, we make a distinction between business and the owner. All the records are kept from the viewpoint of the business rather than from that of the owner. An enterprise is an economic unit separate and apart from the owner or owners. As such, transactions of the business and those of the owners should be accounted for and reported separately. In recording a transaction, the important question is, how does it affect the business? For example, if the owner of a shop were to take cash from the cash box for meeting certain personal expenditure, the accounts would show that cash had been reduced, even though it does not make any difference to the owner himself. Similarly, if the owner puts cash into the business, he has a claim against the business for capital brought in. This distinction can be easily maintained in the case of a limited company, because a company has a legal entity, or personality, of its own. Like a natural person, it can engage itself in economic activities of producing, owning, managing, storing, transferring, lending, borrowing and consuming commodities and services. Distinction, however, is difficult in the case of partnership, and even more so in the case of one-man business. Accounting still maintains separation of business and owner. This implies that owners' personal and household expenses or obligations, e.g., expenditure on food, clothing, entertainment, debts, mortgages, etc., will not appear in the books of account. It may be clarified that it is only for accounting purposes that partnerships and sole proprietorships are treated as separate and apart from the owners, though law does not make such distinction. A creditor would be justified in looking to both the business assets and the private estate of the owner for satisfaction of his claim. One reason for this distinction is to make it possible for the owners to have an account of the performance from those who manage the enterprise. The managers are entrusted with funds supplied by owners, banks and others. They are responsible for the proper use of the funds. The financial accounting reports are designed to show how well this responsibility has been discharged. Activity 1.1. Apart from the reason mentioned above, can you think of any other reason for justification of business entity concept? Activity 1.2. The proprietor of a firm withdrew Rs. 50,000 for his personal use. This was shown as an expense of the firm. Profits were reduced to pay a lower tax. Is this right from accounting point of view? Money measurement concepts. In accounting, only those facts which can be expressed in terms of money are recorded, as money is accepted not only as a medium of exchange but also as a store of value. It has a very important advantage since a number of widely different assets and equities can be expressed in terms of a common denominator. Without these adding heterogeneous factors like 5 buildings, 10 machines, 6 trucks will not have much meaning. While money is probably the only practical common denominator and a yardstick, we must realize that this concept imposes two several limitations. In the first place, there are several facts which, though vital to the business, cannot be recorded in the books of account because they cannot be expressed in money terms. For example, the state of health of the managing director of a company who has been the key contributor to the success of business is not recorded in the books. Similarly, the fact that the production manager and the chief internal auditor are not on speaking terms, or that a strike is about to begin because labor is dissatisfied with the poor working conditions in the factory, or that a competitor has recently taken over the best customer, or that it has developed a better product and so on will not be recorded even though all these events are of great concern to the business. From this standpoint, one could say that accounting does not give a complete account of the happenings in the business. You will appreciate that all these have a bearing on the future profitability of the company. Secondly, use of money implies that a rupee today is of equal value to a rupee 10 years back or 10 years later. In other words, we assume stable or constant value of rupee. In the accounts, money is expressed in terms of its value at the time an event is recorded. Subsequent changes in the purchasing power of money do not affect this amount. You are perhaps aware that most economies today are in inflationary conditions with rising prices. The value of a rupee of 1980s has depreciated to an unbelievably low level in the 90s. Most accountants know fully well that purchasing power of rupee does change, but very few recognize this fact in accounting books and make allowance for changing price level. This is so despite the fact that accounting profession has devoted considerable attention to this problem and numerous suggestions have been made to account for the effects of changes in the purchasing power of money. In fact, one of the major problems of accounting today is to find means of solving the measurement problem, that is, how to extend the quality and the coverage of meaningful information. It will be desirable to present in a supplementary analysis the effect of price level changes on the reported income of the business and the financial position. Activity 1.3. Suppose the managing director of a company is killed in a plane crash. 2. The extent an organization is the lengthened shadow of a man. The real value of the company will change immediately and this will be reflected in the market price of the company shares. Will this have any effect as far as the accounts of the company are concerned? Continuity concept. Accounting assumes that the business, an accounting entity, will continue to operate for a long time in the future unless there is good evidence to the contrary. The enterprise is viewed as a going concern, that is, as continuing in operation, at least in the foreseeable future. The owners have no intention, nor have they the necessity to wind up or liquidate its operations. This assumption is of considerable importance, for it means that the business is viewed as a mechanism for adding value to resources it uses. The success of the business can be measured by the difference between output values, sales or revenues, and input values, expenses. Therefore, all unused resources can be reported at cost rather than at market values. The assumption that the business is not expected to be liquidated in the foreseeable future, in fact, establishes the basis for many of the valuations and allocations in accounting. For example, depreciation or amortization procedures rest upon this concept. It is this assumption which underlies the decision of investors to commit capital to enterprise. The concept holds that Continuity of business activity is the reasonable expectation for the business unit for which the accounting function is being performed. Only on the basis of this assumption can the accounting process remain stable and achieve the objective of correctly recording and reporting on the capital invested, the efficiency of management, and the position of the enterprise as a going concern. Under this assumption, neither higher current market values nor liquidation values are of particular importance in accounting. This assumption provides a basis for the application of cost in accounting for assets. However, if the accountant has good reasons to believe that the business, or some part of it, is going to be liquidated or that it will cease to operate, say, within a year or two, then the resources could be reported at their current values, or liquidation values. Activity 1.4. A company revalues its buildings which were purchased at a cost of Rs. 500,000 in 2005 to Rs. 5 million in 2021 and records the difference of Rs. 4,500,000 as profit for the year 2021. Is this practice right? Cost concept. The resources, land, buildings, machinery, property rights, etc., that a business owns are called assets. The money values that are assigned to assets are derived from the cost concept. This concept states that an asset is worth the price paid for or cost incurred to acquire it. Thus, assets are recorded at their original purchase price, and this cost is the basis for all subsequent accounting for the assets. The assets shown on the financial statements do not necessarily indicate their present market worth or market values. This is contrary to what is often believed by an uninformed person reading the statement or report. The term "book value" is used for amount shown in the accounting records. In case of certain assets, the accounting values and market values may be similar. Cash is an obvious example. In general, the longer an asset has been owned by the company, the lesser are the chances that the accounting value will correspond to the market value. The cost concept does not mean that all assets remain on the accounting records at their original cost for all time to come. The cost of an asset that has a long but limited life is systematically reduced during its life by a process called depreciation, which will be discussed at some length in a subsequent unit. Suffice it to say at this point that depreciation is a process by which the cost of the asset is gradually reduced, or written off, by allocating a part of it to expense in each accounting period. This will have the effect of reducing the profit of each period. In charging depreciation, the intention is not to change depreciation equal to the fall in the market value of the asset. As such, there is no relationship between depreciation and changes in market value of the assets. The purpose of depreciation is to allocate the cost of an asset over its useful life and not to adjust its cost so as to bring it closer to the market value. You must be wondering as to why assets are shown at cost even when there are wide differences between their costs and market values. The main argument is that the cost concept meets all the three basic criteria of relevance, objectivity and feasibility. Accrual concept. The accrual concept makes a distinction between the receipt of cash and the right to receive it, and the payment of cash and the legal obligation to pay it. In actual business operations, the obligation to pay and the actual movement of cash may not coincide. The accrual concept recognizes this distinction. In connection with the sale of goods, revenue may be received I. before the right to receive arises, or E. after the right to receive has been created. The accrual concept provides a guideline to the accountant as to how he should treat the cash receipt and the rights related thereto. In the former case, the receipt will not be recognized as the revenue of the period for the reason that the right to receive the same has not yet arisen. In the latter case, the revenue will be recognized even though the amount is received in the subsequent period. Similar treatment would be given to expenses incurred by the firm. Cash payments for expenses may be made before or after they are due for payment. Only those sums which are due and payable would be treated as expenses. If a payment is made in advance, i.e., it does not belong to the accounting period in question, it will not be treated as an expense, and the person who received the cash will be treated as a debtor until his right to receive the cash has matured. Where an expense has been incurred during the accounting period, but no payment has been made, the expense must be recorded and the person to whom the payment should have been made is shown as a creditor. Activity 1.5. The accounting year of a firm closes on the 31st of December each year. The rent For business premises of 50,000 rupees for the last quarter could not be paid to the owner on account of his being away in a foreign country. Should the rent payable be taken into account for computing the firm's income for the accounting year? Activity 1.6. A government contractor supplies stationery to various government offices. Some bills amounting to Rs. 10,000 were still pending with various offices at the close of the accounting year on the 31st of March. Should the businessman take the revenue of 10,000 rupees into account for computing the net profit of the period? Concept of conservatism. The concept of conservatism, also known as the concept of prudence, is often stated as, anticipate no profit, provide for all possible losses. This means an accountant should follow a cautious approach. He should record lowest possible value for assets and revenues, and the highest possible value for liabilities and expenses. According to this concept, revenues or gains should be recognized only when they are realized in the form of cash or assets. Usually legally enforceable debts, the ultimate cash realization of which can be assessed with reasonable certainty. Further, provision must be made for all known liabilities, expenses and losses whether the amount of these is known with certainty or is at best an estimate in the light of the information available. Probable losses in respect of all contingencies should also be provided for. A contingency is a condition or a situation, the ultimate outcome of which gain or loss cannot be determined accurately at present. It will be known only after the event has occurred, or has not occurred. For example, a customer has filed a suit for damage against the company in a court of law. Whether the judgment will be favorable or unfavorable to the company cannot be determined for sure. Hence, it will be prudent to provide for likely loss in the financial statements. As a consequence of the application of this concept, net assets are more likely to be understated than overstated, and income is more likely to be overstated than understated. Based on this concept is the widely advocated practice of valuing inventory, stock of goods left unsold, at cost or market price, whichever is lower. You will note that this convention, in a way, modifies the earlier cost concept. It should be stated that the logic of this convention has been under stress recently. It has been challenged by many writers on the ground that it stands in the way of fair determination of profit and the disclosure of true and fair financial position of the business enterprise. The concept is not applied as strongly today as it used to be in the past. In any case, conservatism must be applied rational. Why? As over-conservatism may result in misrepresentation. Materiality concept. There are many events in business which are trivial or insignificant in nature. The cost of recording and reporting such events will not be justified by the usefulness of the information derived. Materiality concept holds that items of small significance need not be given strict theoretically correct treatment. For example, a paper stapler costing Rs. the 30th of May last for 3 years. However, the effort involved in allocating its cost over the 3-year period is not worth the benefit then can be derived from this operation. Since the item obviously is immaterial when related to overall operations, the cost incurred on it may be treated as the expense of the period in which it is acquired. Some of the stationery purchased for office use in any accounting period may remain unused at the end of that period. In accounting, the amount spent on entire stationery would be treated as expense of the period in which the stationery was purchased, notwithstanding the fact that a small part of it still lies in stock. The value, or cost, of the stationery lying in stock would not be treated as an asset and carried forward as a resource to the next period. The accountant would regard the stock lying unused as immaterial. Hence, the entire amount spent on stationery would be taken as the expense of the period in which such expense was incurred. Where to draw the line between material and immaterial events is a matter of judgment and common sense. There are no hard and fast rules in this respect. Whether a particular item or occurrence is material or not, should be determined by considering its relationship to other items and the surrounding circumstances. It is desirable to establish and follow uniform policies governing such matters. Consistency concept. In practice, there are several ways to record an event or a transaction in the books of account. For example, the trade discount on raw material purchased may be deducted from the cost of goods and net amount entered in the books. Or alternatively, trade discount may be shown as the income with full cost of raw material purchased entered in the books. Similarly, there are several Methods to charge depreciation, which is a decrease in the value of assets caused by wear and tear, and passage of time, on an asset or of valuing. Inventory. The consistency concept requires that once a company has decided on one method and has used it for some time, it should continue to follow the same method or procedure for all subsequent events of the same character, unless it has a sound reason to do otherwise. If for valid reasons the company makes any departure from the method it has been following so far, then the effect of the change must be clearly stated in the financial statements in the year of change. You will appreciate that much of the utility of accounting information lies in the fact that one could draw valid conclusions from the comparison of data drawn from financial statements of one year with data of the other year. Comparability is essential so that trends or differences may be identified and evaluated. Inconsistency in the application of accounting methods might significantly affect the reported profit and the financial position. Further, inconsistency also opens the door for manipulation of reported income and assets. The comparability of financial information depends largely upon the consistency with which a given class of events are handled in accounting records year after year. Activity 1.7. A company had been charging depreciation on a machine at Rs. 10,000 per year for the first 3 years. Then it began charging Rs. 9,000 for 4th year and Rs. 7,800 for 5th year, and so on. Is this practice justified? Give reasons for your answer. Periodicity concept. Although the results of operations of a specific enterprise can be known precisely only after the business has ceased to operate, its assets have been sold off and liabilities paid off, the knowledge of the results periodically is also necessary. Those who are interested in the operating results of business obviously cannot wait till the end. The requirements of these parties therefore force the accountant to report for the changes in the wealth of a firm for short time periods. These time periods in actual practice vary, though a year is the most common interval as a result of established business practice, tradition, and government requirements. Some firms adopt calendar year, some others financial year of the government. But more and more firms are changing to the natural business year, the end of which is marked by relatively lower or lowest volume of business activity in the 12-month period. The custom of using 12-month period is applied only for external reporting. The firms usually adopt a shorter span of interval, say 1 month or 3 months, for internal reporting purposes. The allocation of long-term costs and the difficulties associated with this process directly stem from this concept. While matching the earnings and the cost of those earnings for any accounting period, all the revenues and all the costs relating to the year in question have to be taken into account, irrespective of whether or not they have been received in cash or paid cash. Despite difficulties that there is in allocations and adjustments, short-term reports, i.e., yearly reports, are of such importance to owners, management, creditors, and other interested parties that the accountant has no option but to resolve such difficulties. Obviously, the utility of the periodic financial statements outweighs the difficulties. While going through all these concepts, probably you have developed a feeling that they come in conflict with each other. You are right. We illustrate this by considering some of these concepts in the context of valuation of business properties. Suppose a firm acquired a piece of land in 2017 for a price of 600,000 rupees. Factory premises were constructed in 2018 and operations commenced in 2019. The firm has been successful in achieving desired profit for the past year. The balance sheet, a statement of assets and liabilities, for the year 2019 is being prepared and land is required to be valued. The estimated current market price of this land is Rs. 6 million. Should you recommend that the land be valued at Rs. 60 lakhs? The answer is no, obviously. The land would be carried on the balance sheet at its original cost of Rs. 600,000 only. This decision is supported by several of the concepts discussed in this section. In the first place, the stability of purchasing power of money implied in the money measurement concept prevents us from recognizing accretion in values as a result of changing price levels. Then, the realization concept will not allow unreal said profits to be included as long as land is held by the company and not sold away. You may note that the continuity or going concern concept makes any possible market value of land is irrelevant for balance sheet because the firm has to continue in business and land will be needed by it for its own use.